In this video, I'm going to discuss the top 5 ETFs to buy for passive income. I love this type of investing as a safe and simple way to achieve financial freedom. There are thousands of ETFs globally, but not all are created equal. These ETFs have everything we're looking for to generate massive long-term wealth. First up to bat is VTI, or Vanguard Total Stock Market Fund. With just one share, you get 3,900 companies that track the whole market. These consist of reputable and well-established companies. It tracks everywhere from the mid-cap to the large-cap stocks. This is one of the largest ETFs. It tracks the CRSP US Total Market Index. Top holdings of this ETF include Apple, Microsoft, Amazon, Facebook, and Google. It is very well diversified with many sectors. Tech is the top sector at 32%, while other sectors include consumer cyclicals, healthcare, industrials, energy, and financials. 1-year return is 33%, while a 10-year return is 16% every year. Expense ratio is a measly 0.03% and a dividend yield of 1.26%. Pretty modest. VTI is a great choice for long-term investors to have a fully diversified portfolio and to buy and hold for years. As Forbes suggests, the lazy portfolio is all that the future millionaires need. This means long-term investors only need to have 3 things in their portfolio, and that is 55% in US stocks, 10% in bonds, and 35% in international stock market. With an expense ratio of 0.03%, this is a great way to start creating that lazy growth portfolio. Coming in at number 4 is the SCHG, or the Schwab Large Cap Growth ETF. This tracks the stocks of the Dow Jones US Large Cap Total Stock Market Index. This ETF is perfect for long-term investors who intend to invest for 10 years or more because it is expected to have better returns than the US stock market. This is great for a growth portfolio because returns are consistent and have less risk than individual stock choices. It selects stocks from the 750 largest growing companies. Top 10 holdings include Apple, Microsoft, Amazon, Facebook, and Google. As you can see, in the last year, the stock has been in a steady growth trajectory with slight volatility. SCHG has a small dividend of 0.43% and an expense ratio of 0.04. So why am I bringing up expense ratios? Low expense ratios equal higher returns. This means that you are paying very little for low expense ratios to keep the ETF managed. As John Bogle, the founder of Vanguard, says, the miracle of compound return is overwhelmed by the tyranny of compounding costs, or expense ratios. This is mainly a technology ETF with a staggering 59% allocation to the tech sector. Consumer cyclicals comes in at 17%. 1-year return is 32% and 10-year return is 19%. It has only gone down twice in 10 years. This is wonderful for long-term investors who are looking for a more high-growth portfolio, but still to be very diversified. The third top ETF is VOO, or the Vanguard S&P 500. This is a very low-risk ETF and extremely popular. It is the benchmark portfolio to beat for many portfolio managers. Please note that around 82% of portfolio managers do not beat the market and do not beat this benchmark specifically, so this is a great choice for retail investors to hold forever. VOO tracks a market cap weighted index of US large and mid cap stocks selected by the S&P committee. The S&P 500 are the United States 500 best companies. So basically, you're getting the top players in the United States in a little boat served on a platter. Top 10 holdings include Apple, Microsoft, Amazon, Facebook, and Google. This is a very consistent ETF with the tech sector allocated at 34%. Other sectors include healthcare, financials, consumer, discretionary, and communication services. It has a 1-year return of 31% and 10-year return of 16%. Expense ratio is 0.03% and dividend yield is 1.34%. Note that the S&P 500 provides an average of 8% per year return, while the dollar decreases 2% per year. So you may be thinking, but the stocks look overvalued. Well, in my research, they're actually fairly valued, and some can even go up quite substantially. For example, Apple is trailing the market yield to date, and Google is fairly valued with an upside of 10% according to 30 tip rank analysts. VU is perfect for long-term holders who want passive income, are kind of busy, don't know that much about investing, or are low-risk investors. The second and a half top ETFs are QQQ and QQQM. Say that 3 times fast. This tracks the NASDAQ 100 index, and it is found mostly with the tech sector and does not include traditional financials. The dividend yield is 0.49%, which is lower than VU because it primarily holds tech. Tech companies tend to reinvest their free cash flow into research and development, which means that dividend yields tend to be a bit lower. It has an expense ratio of 0.20. As you can see, the expense ratio is a bit higher because we're trying to get higher reward. The 1-year price chart is in a consistent upward trend. However, as you can see, it fluctuates a bit more, meaning it's a bit more volatile. Allocation is primarily in tech with a 64% exposure and 21% exposure in consumer cyclicals. There are no traditional financial stocks in the sector because finance is supposed to be disrupted by fintech. While I personally love MasterCard over Visa, I also think fintech is going to be a big disruptor with Square and PayPal. The top 10 holdings are Apple, Microsoft, Nvidia, and PayPal. So we see instead of finances, we have fintech giant PayPal because it's supposed to be a higher growth. 1-year return is 30% and 10-year return is 22%. Wow. This is a bit of a higher risk ETF, but it is great for long-term investors who want a high risk, high reward play. Now you may be seeing names that are coming up over and over again on these ETFs. So should you just buy the stocks separately? Well, if you are a passive investor, then you want to focus on the US or the global economy and invest in that outright. Now, if you are more of a speculator or you want higher returns, possibly with a lot more risk, and you're willing to research daily and keep up with the news of a specific stock, then you can own a stock separately. But I would say for a busy or passive investor, ETFs are the way to go because you're investing in the economy and not just one company. As Benjamin Graham, the father of value investing and author of Intelligent Investor, which you need to read, says, there are 2 ways to be an intelligent investor: by continually researching, selecting, and monitoring a dynamic mix of stocks, bonds, and mutual funds, or by creating a permanent portfolio that runs on autopilot and requires no further effort, but generates very little excitement. One great advantage of ETFs as opposed to index funds is that you can pay the price you want at the time you want. Now, this is wonderful, and I have a video in the link in the description below of when is the best time to buy and sell ETFs. Usually from historical data. So if you want to watch that, that's the link in the description below after you watch this video. Now, if you want to check out the QQQM, that's the next ETF we're talking about. This is exactly like the QQQ, but it has a lower expense ratio of 0.15%. So shouldn't I just invest in the QQQM? Well, it depends on how much money you're actually putting into it. First, you need to consider trading costs. Generally speaking, the larger a fund is and the more people it has trading shares, the lower the spread. Just stay with me here, this will make sense in a minute. So the QQQM have assets of about $1 billion, while the QQQ have assets of $150 billion. So essentially, the QQQM has a larger spread with 3 additional basis points. This means that the expense ratio for the QQQM is actually 0.18%, while the QQQ is 0.2%. Now, institutional investors and investors with a lot of money love the QQQ because it has a lot of liquidity, while retail investors with not so much money love the QQQM because it does provide slightly a little less expense ratio. The top ETF is SCHG. SPY. This is the oldest and most recognized US ETF. It has the biggest AUM, or assets under management, and daily traded volume, which makes it great for day traders or selling covered calls. This tracks the S&P 500 just like VOO does, and of course the top 10 holdings are Apple, Amazon, Microsoft, Facebook, and Google. It is very diverse and spread across 11 sectors. So since technology is the largest sector in the US right now, it mostly tracks that with 1/3 of its portfolio exposure in technology. The second one is consumer cyclicals. It has a 1-year return of 30% and 10-year return of 16%. Now that's per year. It has an expense ratio of 0.09% and a dividend yield of 1.3%. This and VOO are the best ETFs to buy if you are a beginner, if you're new to the investing world, if you're busy, or if you are a low risk investor. You can just set and forget these and hold them forever. So these are the top 5 ETFs to hold for financial freedom. Now, investing doesn't need to be hard or complicated, it just takes patience. While the market is always changing, these are solid ETFs in which to invest if you believe the economy will grow over time, which it has since the New York Stock Exchange started. So these are great ETFs to buy no matter what the stock market is doing, but you do need to know a few things about what ETFs are, what you need to avoid if you're looking for other stocks. So in my next video, on Monday at lunchtime, we're going to talk all things ETFs, what to look out for, what the advantages are, what are they, if you're interested in other ETFs, what you need to know before you buy. So make sure to leave a like and subscribe to this channel. Click the little bell notification so you will know when a video comes out. I hope to see you soon. This is Supergirl Investor, here to save the world and make you wealthy. Please click the link in the description below to check out all of my videos, all the things, and to get a free newsletter where we talk everything money, finance, and investing. Happy investing! If you would like 2 free stocks and to support the channel, sign up for Webull, link in the description, and as a bonus, get a free year membership to the Supergirl Investor community where we learn how to be wealthy and save the world.